Open. Blackstone just raised $1.75 billion in the IPO of its data center REIT, and the financial press covered it the way they always cover Blackstone, as a headline number, a proof of institutional appetite, a signal that AI infrastructure is still the trade. That's the retail read. The institutional read is more specific and considerably more useful. What that IPO actually did is establish a public market pricing benchmark for data center real estate at a moment when private deal flow in the mid-market is not caught up. The spread between where Blackstone just printed and where I'm seeing off-market assets trade is still wide. Not permanently wide. These gaps compress, but wide enough right now that if you are an operator sitting on powered land, a legacy colocation facility, or a carrier hotel asset in a secondary market, and you have not had a serious recapitalization conversation, you are leaving bases on the table. That's what this video is about. The data layer. Let's start with what Blackstone actually built and what the IPO tells us about pricing. The vehicle is Blackstone Real Estate Income Trust's data center spin-out, operating under the AirTrunk acquisition they closed in late 2024 for approximately $16 billion, one of the largest data center transactions ever executed. AirTrunk at acquisition was running roughly 800 megawatts of operational and under development capacity across Australia, Japan, Singapore, Malaysia, and Hong Kong. The $1.75 billion IPO represents a partial public float of that platform, and the pricing implies a valuation framework that institutional buyers are now using as a comp. Here's why that matters mechanically. Prior to this IPO, the dominant public comps for data center real estate were Equinix, trading at roughly 26 to 28 times EBITDA, and Digital Realty, trading closer to 20 to 22 times. With Iron Mountain's data center segments somewhere in between depending on how you strip the REIT structure. Green Street's data center coverage had been flagging a premium to NAV of 15 to 20% for the major listed platforms through most of 2024. What Blackstone's IPO does is introduce a new data point, a freshly priced institutional vehicle, post-AI CapEx cycle repricing, with hyperscaler pre-lease commitments baked into the underwrite. That's not the same asset as a 10-megawatt mid-market colo facility in Nashville or Columbus, but it anchors the conversation about what the asset class is worth to long-duration institutional capital. On the private side, CBRE's 2024 Global Data Center Trends Report put average cap rates for stabilized North American data center assets in the 5.5 to 6.5% range, with hyperscaler-leased facilities at the tight end and multi-tenant colo compressing toward that band. JLL's data center outlook from the same period flagged that absorption in primary markets, Northern Virginia, Dallas, Chicago, Phoenix, Silicon Valley, had outpaced new supply for 6 consecutive quarters. Real Capital Analytics transaction data showed that deal volume in the data center sector exceeded $50 billion globally in 2023, with the top 10 transactions accounting for roughly 60% of that volume. That concentration tells you something. Institutional capital is doing mega deals, and the sub-$100 million transaction is not getting the same underwriting attention. The vacancy rate in Northern Virginia, the world's largest data center market by capacity, sat below 1% through most of 2024 according to CBRE. Phoenix, which was supposed to be the relief valve, sought pre-leasing absorb new supply before delivery. Secondary markets, Indianapolis, Salt Lake City, Raleigh-Durham, San Antonio, are seeing the same demand dynamics on a lag, but power constraint is the binding variable everywhere. The mechanism. Why is institutional consolidation happening now, at this pace, at this price? 3 converging pressures. First, power scarcity has become the underwriting variable. It used to be that data center deals were underwritten on lease rate per kilowatt, tenant credit, and location. Now the conversation starts with, do you have permitted megawatts? What's your utility queue position? And what is your PUE? Dominion Energy's interconnection queue in Northern Virginia has wait times that are measured in years, not months. AES, Duke, and PSEG are all managing similar dynamics in their respective territories. This means that an operator who got into the utility queue 3 years ago and holds a power agreement, even on an underdeveloped or undercapitalized site, is sitting on an asset that institutional buyers cannot replicate quickly. That's a real option, and it has real value. Second, the hyperscaler CapEx cycle is pulling forward demand in a way that's not fully priced into secondary market assets. Microsoft committed to $80 billion in data center CapEx in fiscal 2025. Google's parent Alphabet disclosed $75 billion in planned infrastructure spend. Meta guided toward a similar range. These are public 10K and earnings disclosure numbers, not projections I'm making. That capital has to land somewhere, and the hyperscalers cannot build fast enough on their own. They're signing 10 to 20-year triple net leases with developers who can deliver power. The lease structures are the closest thing to investment-grade fixed income that exists in commercial real estate right now. A 15-year and lease with Microsoft or Google as the tenant is not a cap rate story, it's a credit story, and institutional buyers are pricing it accordingly. Third, the debt maturity wall in legacy data center infrastructure is creating forced recapitalization events. A meaningful segment of mid-market colo operators financed their builds in 2018 to 2021 on 5 to 7-year bridge structures. Those maturities are hitting now, in a rate environment that is materially higher than their original underwrite. If you built at a 6% all-in cost of capital and you're rolling debt at 7.5 to 8.5% with a lender who's also running regulatory capital constraints, your capital stack has a problem. That's not distress in the traditional sense, but it is a recapitalization opportunity for equity that can move without a committee. Where mid-market capital fits, the Blackstone IPO priced a hyperscale adjacent, multi-geography, institutional-grade platform. That is not the deal I'm looking at. The deal I'm looking at is the operator in a secondary or emerging market who has 5 to 30 megawatts of operational capacity, a legitimate utility relationship, and either a debt maturity problem or a growth capital need that the regional banks are not equipped to solve. The specific subsegment that's mispriced right now, carrier hotels and legacy colo facilities in markets with constrained new supply. These are assets that were built in the early 2000s, financed conservatively, often owned by founders or regional operators who have not recapitalized in a decade. They're not hyperscale, they're not getting covered by the Green Street analysts, but they are generating stabilized cash flows on infrastructure that cannot be replicated quickly because of power, zoning, and fiber density. A carrier hotel in a mid-size metro with 40 to 50 tenants and a weighted average lease term of 4 years is not a trophy asset, but it's also not trading at 26 times EBITDA. There is a real basis gap there. The structure that works in this segment is a preferred equity or structured JV at the asset level, not a fund commitment. I'm looking at deals where I can come in at 65 to 70% of stabilized value, preferred return in the 10 to 12% range, with a clear path to either a recap at institutional pricing within 24 to 36 months or a strategic sale to one of the platforms that is actively consolidating. QTs, Switch under American Tower's umbrella, CyrusOne, Aligned Data Centers. These are real buyers with real acquisition mandates and real price discovery from the public markets. Powered land is the adjacent opportunity. An entitled site with a substation agreement and 20 plus megawatts of available capacity in a constrained market is not a real estate deal, it's an infrastructure option. I'm seeing these assets trade at significant discounts to intrinsic value because the sellers are real estate people who are pricing on comps rather than on replacement cost or option value. That's the entry point. Counter positions and risks. The bears are right about several things and I won't gloss over them. Power delivery timelines are a real execution risk. A utility agreement is not a delivered megawatt. I've seen deals where the substation upgrade was 18 months out at signing and became 36 months out post-closing due to equipment lead times, specifically large power transformers, which are on multi-year lead times globally. That slippage can destroy an IRR on a development deal even if the demand thesis is correct. The hyperscaler concentration risk is also real. A 15-year lease with one tenant is investment grade until that tenant decides to insource, renegotiate at renewal, or shift workloads. Google and Microsoft have both demonstrated willingness to walk away from lease renewals when pricing doesn't work for them. Single-tenant dependency at the asset level is a structural risk that needs to be priced, not assumed away. There is also a legitimate question about whether AI workload demand sustains at the capital intensity that the current cycle implies. The efficiency gains from models like DeepSeek's are one, which generated significant discussion in early 2025 around inference efficiency, raise a real question. If the compute required per query drops materially, does the demand for raw capacity moderate? I don't think the demand story reverses, but the slope of the curve may be less steep than the hyperscaler capex guidance implies. Finally, the public-to-private spread compresses. It always does. The window for alpha generation from the basis gap is not permanent. Institutional buyers are not slow. Once the IPO benchmark circulates through the M&A advisory community, the bid for secondary and tertiary market assets will move. The question is whether you're sourcing and closing before that happens. The position I'm taking. My team is actively evaluating two categories right now. First, structured equity in operational carrier hotel and colo assets in the $10 to $40 million equity check range, specifically in markets where fiber convergence and existing tenant density creates switching cost moats. We're looking at the Midwest and Southeast, not because they're fashionable, but because the land-constrained supply picture in Indianapolis, Columbus, Charlotte, and Birmingham is tightening on the same power dynamics as primary markets, at pricing that is 200 to 400 basis points wider on a cap rate basis. Second, I'm in conversations with operators who hold permitted powered land, specifically sites with executed generator agreements or substation capacity, who need a capital partner to bridge to either development or a strategic sale. The structure I am proposing is a joint venture with a preferred equity tranche covering the capital costs through to a defined liquidity event, with a promoted carry that aligns incentives on execution timeline. If you are sitting on an asset like this and you have not explored what recapitalization looks like in this environment, the conversation is worth having. I'm not chasing hyperscale development. I don't have the balance sheet to compete with Blackstone, Brookfield, or DigitalBridge on a 200-megawatt campus deal. But that's not where the alpha is right now anyway. The alpha is in the assets that are too small for institutional mandate minimums and too operationally complex for passive capital, and that's exactly where I want to be. Close. The Blackstone IPO is a benchmark event. It tells you what institutional capital is willing to pay for data center real estate with hyperscaler credit and long duration. What it also tells you, if you're reading it correctly, is that the private market has not fully repriced. The spread between where that IPO printed and where off-market assets are transacting is still real. It won't stay that way. Mid-market operators with powered land, stabilized colo cash flows, or carrier hotel assets need to understand what their assets are worth in this environment and decide whether now is the moment to recapitalize, sell, or bring in a structured equity partner before that spread closes. If you're a deal broker with a vetted opportunity in this space, or an operator or principal who wants to talk structure and valuation, DM me at @BrodyOfficial. I route every inquiry personally.